All right, besides the macro picture, of course, earnings season's in full swing right now, and investors are keeping a close eye on the winners and losers who are reporting. It's easy to get lost in these reports. What exactly should we be looking for when thumbing through the numbers? It's time for Yahoo You. Our very own Brian Cheung is here with this week's lesson. How do you read that income statement?
Hi, all right, well, class is in session, and today we're going to talk about income statements. And it's not just earnings, it's also IPOs, too. We were digging through Slack, for example, but we talk a lot about top line, bottom line. So what does it all mean? Well, to illustrate it, let's come up with a fake company, for example. We'll call it Cheung's Shoes. So I, for example, manufacture shoes. And what we're looking at right now on the screen is revenue, right? So this is the amount of money. And by the way, this was our producer Val's idea. This was not my idea to put my face on the screen. But let's say Cheung's Shoes makes $100 million in revenue. This is the amount of money that I make off of just selling the sneakers itself. We take this number and we subtract it by the expenses. So basically, the expenses, how much I need to spend to make those shoes. So for example, the shoelaces, I need to get fabric to make that together. I need to get rubber to put on the bottom of the shoes. I spent $30 million this quarter on that. Now, that equals net income. And net income is basically taking the money that I made, subtracted by the amount that I spent to make those things, and I get $70 million. Now, that's how much I have after I account for all of those changes. But also now we're looking at how much money do I give out to the shareholders who have stock in Cheung's Shoes. So Julie and Adam, you have shares in Cheung's Shoes. So you are part of the 10 million outstanding shares that exist. So we divide 70 million by 10 million. That gives us the earnings per share. And EPS is basically the bottom line. That is effectively $7 when we divide 70 by 10. And that is how much money each share will get in terms of the amount of earnings that I have made. Now, this is a very simplistic way of looking at it. This is basically in its purest form. It gets a little bit more complicated than that. This is the whole equation. So again, top line revenue, bottom line being net income, EPS being what we talk about in these earnings reports. But actually, in reality, there's a lot more other income lines that are on the income statement as well. We talk about EBITDA, for example, right? What does EBITDA mean? Well, EBITDA is an acronym. It stands for earnings before interest, taxes, depreciation, and amortization. So in reality, you'll see on the screen ahead of you that there's actually, in addition to net income, you have to pay for depreciation. If I have a warehouse, for example, that loses value over time, or equipment that also loses value over time, you also have interest that you have to pay because I had to take a bank loan to get the mortgage on that warehouse or buy that equipment. And of course, you can't forget about taxes, what I owe to the state, what I also owe to the federal government. So on the bottom line, it's really the net earnings of $45 million in this fake scenario. Of course, EBITDA is basically controlling for all of those other factors, which are really out of my control. I don't control the tax rate. I don't control how much my warehouse depreciates. So when we talk about EBITDA, in this case, it would be $70 million. That's simply the $100 million that I made subtracted by the $30 million that I had to spend to make those goods. Now, we talk also about an earnings recession. That's something we've been hearing a lot about recently. The earnings recession is kind of talking about guidance, for example. So we've heard a number of companies over the fourth quarter and also in the first quarter talk about how they actually have a gloomier outlook for 2019, partially because of an economic slowdown abroad that might spill over into the U.S. or concerns about the underlying U.S. economy to begin with. This comes from BMO Capital Markets. What you're looking at here is essentially purple being earnings that have already been reported and blue earnings that are being projected based on what we've heard from companies regarding their outlook for 2019. You can see that basically there's an inflection point and that Q1 could be worse than Q4 and that it'll actually basically come into a slow grind as we've seen in the past that earnings actually are quite cyclical. So the question now being, will all these companies, including Cheung's Shoes, face an earnings recession? Well, that's an interesting question that we'll need to see as more companies report through the rest of this year.
But just to be clear, an earnings recession isn't just slowing growth. It would be if the numbers went negative, right?
Negative
it would be
EPS
if earnings started falling.
Right. So for the moment, there are a few companies that have had some bad results and bad projections, but they've slowly notched down their earnings expectations for 2019. So if we do end up getting to the point where they do start forecasting negative earnings, then we would categorically be in an earnings recession.
You forgot to factor in the contract with LeBron James for the shoes, the $1 billion that you're going to have to adjust for as you go forward.
The Air Adam 2s are
yeah, there you go.
We're in production. They'll be coming out soon.